Imagine waking up every morning without worrying about going to work, yet still receiving enough money to cover all your expenses. Sounds like a dream, right? That's the promise some investment strategies claim to offer, especially those featuring high dividend ETFs. Recently, headlines have been screaming numbers like 28% annual yield from certain ETFs. At first glance, this seems like a shortcut to financial freedom. But is it really possible to earn more from a single investment than a full-time income? In this video, we will break down exactly how these high-yield ETFs work, the risks involved, and whether they could realistically replace a traditional paycheck. Understanding dividend ETFs and yields. Before we dive into the 28% claim, let's clarify what a dividend ETF is. A dividend ETF is a fund that owns a collection of dividend-paying companies. These ETFs pay out a portion of the profits from these companies to investors, usually on a quarterly or monthly basis. The yield is simply the total annual dividend payments divided by the price of the ETF. A 28% yield means that if you invested $10,000, you could receive $2,800 in dividends over a year. However, yields this high are extremely rare and usually come with significant risk. For comparison, some of the most popular and stable dividend ETFs in 2025, like Vanguard High Dividend Yield ETF, VYM, yield around 2.5% to 3%, and SPDR Portfolio S and P500 High Dividend ETF, SPYD, yields about 4 to 5%. These funds provide steady income over time and focus on quality companies with a track record of paying dividends. A yield 5 or 6 times higher than what these stable ETFs offer should immediately raise a red flag. Extremely high yields are often a signal that something unusual is going on. Either the underlying companies are struggling or the ETF is using complex strategies to generate extra income. How some ETFs achieve ultra-high yields. To reach yields as high as 28%, ETFs usually rely on non-traditional or aggressive strategies. They may invest heavily in high-yield but risky sectors like real estate investment trusts, REITs, energy companies, or financial firms that pay high dividends. Use option strategies such as covered calls to increase income. This can generate higher cash flow but also limits upside growth and increases risk. Include distressed companies that have high payouts now but uncertain financial futures. While these strategies can produce eye-catching payouts in the short term, they also bring significant risks. Market volatility, interest rate changes, economic downturns, or sector-specific challenges can reduce the share price and even result in dividend cuts. In other words, the 28% you see on paper may not translate to reliable income in reality. The danger of the yield trap. One of the most important concepts to understand in high-yield investing is the yield trap. This occurs when a company's or ETF's share price drops sharply, which temporarily inflates its yield. For example, imagine a company worth $50 per share paying a $3 annual dividend. That's a 6% yield. If the company's stock drops to $20 due to business struggles but still pays $3, the yield jumps to 15%. On the surface, this seems incredible, but the reality is that the company's financial health may be deteriorating. The high yield doesn't signal strength, it signals potential danger. If earnings continue to weaken, the dividend may be cut or eliminated, leaving investors with shrinking income and capital loss. High-yield ETFs that include such companies can expose investors to this exact trap. That's why relying solely on high yields for income can be very risky. Comparing high-yield ETFs with more conservative options. Instead of chasing extreme yields, many investors prefer ETFs that offer moderate yields with stability and diversification. While the payouts are smaller, the risk is significantly lower. Vanguard High Dividend Yield ETF, VYM, a yield of 2.5 to 3%, holding hundreds of large and mid-cap companies across sectors, ensuring diversification and stability. SPDR Portfolio S&P 500 High Dividend ETF, SPYD, a slightly higher yield of 4 to 5%, targeting high dividend companies from the S&P 500. It's more volatile but still focuses on companies with consistent dividend records. Schwab U.S. Dividend Equity ETF, SCHD, focuses on quality dividend growth companies, yielding around 3% with a strong emphasis on sustainable income. These ETFs may not make headlines with huge yields, but over time they deliver consistent income without the extreme risk of a 28% yield ETF. Long-term returns versus yield. Another key point is that high yield doesn't always mean higher returns. ETFs with extremely high yields can be volatile, and the high payouts might not be sustainable. If dividends are cut, your income drops immediately, and if the ETF's share price falls, you lose capital. Historical performance shows that moderate yield ETFs with strong diversification often outperform high-yield, high-risk ETFs over the long term, especially when market conditions are tough. This is because consistent payouts and diversified portfolios reduce the risk of sudden drops in income and share value. In short, chasing the highest yield can feel exciting, but it often leads to unpredictable results. Stability and steady growth usually win out over the long term. Using dividend ETFs as a full-time income replacement. Now, let's talk about replacing a full-time income. To earn, for example, $50,000 per year from dividends alone, you would need, with a 28% yield ETF, approximately $180,000 invested, theoretically. Sounds achievable, but remember, the yield is risky and may not be sustainable. With a moderate 4% yield ETF, like SPYD, approximately $1.25 million invested. Much higher up front, but the payout is stable, reliable, and less likely to disappear. This comparison shows that the high-yield ETFs might look attractive for smaller investments, but the risk can wipe out the gains, making it unreliable for real-life financial planning. Expert advice and recommendations. Financial experts recommend focusing on diversification. Don't put all your money into a single sector or ETF. Spread investments across multiple sectors to reduce risk. Sustainable dividends. Look for ETFs with companies that have strong cash flow and a history of consistent payouts. Moderate yields. Avoid ETFs that promise extremely high payouts unless you understand the risks and can handle volatility. Long-term strategy. Compounding growth, stable dividends, and low fees over decades often outperform high-risk, high-yield chasing. Moderate yield ETFs may not seem flashy, but for building a reliable income stream, they are the safer, more sustainable choice. So, can a 28% dividend ETF really replace a full-time income? Most likely not. While the number looks impressive on paper, it usually comes with high risk, market volatility, and potential dividend cuts. The reality is that extreme yields are often a warning sign rather than an opportunity. If your goal is long-term, reliable income, focus on ETFs with moderate but stable yields, broad diversification, and strong track records. You may need more capital to replace a full-time paycheck, but your income will be far more predictable and sustainable. Remember, investing isn't about chasing the highest number you see on a chart. It's about building a system that generates consistent results over time. In a follow-up video, I can show real examples of dividend ETF portfolios in 2026 that could realistically generate monthly income to supplement or even replace a part-time or full-time paycheck. If you like this video, hit subscribe for more deep dives into the finance world. Drop a comment if you want breakdowns of other confusing finance terms. Thanks for watching.